Well, there's been a lot of talk lately about gold and silver waking up again because of the Strait of Hormuz, shipping risk, oil prices, and this separate argument over bullion taxes. So in this video, we're going to separate what actually matters from what just sounds dramatic. And by the end, you're going to have a cleaner view of why metals are moving and what stackers should not get wrong. Today is Monday, May 4th, New York time. Drop a comment and tell me what day and date you're watching from, because I always like seeing how far these market updates travel. And also, if you value this kind of straight, no-nonsense breakdown, support the channel by subscribing and commenting. Arjan AG. That tells me you want more of this kind of work. Not noise, not hype, just the story taken apart piece by piece. So let's start with the big claim floating around. Gold and silver moved higher because President Trump said the United States would begin helping commercial ships get through the Strait of Hormuz. That part is real. The shipping lane has been under serious pressure. Vessels have been delayed, crews have been stuck, and the market is treating that waterway like the pressure valve it is. But here's where we have to slow down. Because when people hear Strait of Hormuz, they immediately jump to disaster mode. Oil spike, war expansion, metal breakout, emergency buying. And look, I understand why. This is not just some random body of water on a map. Under normal conditions, roughly a fifth of the world's oil and liquefied natural gas trade moves through that narrow corridor. So if traffic there gets restricted, markets do not shrug. They reprice risk. However, risk is not the same thing as certainty, and that distinction matters more than almost anything tonight. The first question is very simple. Did the United States announce an effort to help ships move out of the strait? Yes. Based on recently published reports, the announcement was framed as a humanitarian effort for neutral vessels and crews that had been trapped or slowed by the conflict. That is the core event. The second question is different. Does that automatically mean gold and silver must explode? No. That is where a lot of people get ahead of the facts. So let's take the market reaction apart. At the open, silver was being watched around the mid-70s, and gold was hovering in the mid-4000s. Those are big levels psychologically. People behave differently when prices get high enough to feel unfamiliar. New buyers hesitate. Old stackers get excited. Traders look for momentum. Sellers ask themselves if this is finally the move they were waiting for. And in that kind of environment, one headline can feel bigger than it really is. Now, silver has a special problem here. It is not just a safe haven story. It is also an industrial metal story. So when oil rises, inflation worries rise. When inflation worries rise, rate expectations can change. And when rate expectations change, precious metals can react in ways that confuse people. Sometimes higher fear helps gold and silver. Sometimes higher interest rate pressure holds them back. So if anyone tells you this is a simple straight line, they are skipping half the chart. And this is the part I think a lot of stackers need to hear. A shipping crisis can support metals, but it can also create messy trading. That means bigger candles, sharper pullbacks, wider physical premiums, and more emotional decisions from people who did not plan ahead. So yes, gold and silver had a reason to get attention, but attention is not the same as a confirmed breakout. Now let's talk about the freighter story, because this is where rumors start moving faster than facts. There were reports of vessel attacks near the Strait of Hormuz and off the Iranian coast. That is serious. But saying, with full confidence, that Iran attacked a freighter is stronger than what was clearly confirmed in the early reporting. The safer version is this. Vessels were reportedly attacked near the area. Crews were reported safe in at least one case, and attribution was not clean enough to treat every claim like a settled fact. That may sound like a small correction, but it is not small, because markets respond to wording. A reported attack is one level of risk. A confirmed state-directed attack is another level. And if you mix those up, you can scare people into decisions they would not make if they had the facts in the right order. This is why I do not like building an investment thesis on live chat headlines. Live updates are useful, but they are also messy. People hear one sentence, add their own conclusion, and before you know it, a possibility turns into a fact. Now, oil is another piece of this. Some people were expecting crude to drop below $100 because if the United States helps ships move, maybe the supply risk premium cools off. And logically, I get it. If traffic moves better, insurance risk can ease, shipping confidence can improve, and traders can remove some fear premium. But that is only one side of a ledger. The other side is that oil stayed above $100 in recent market updates, with global crude still sitting in triple-digit territory. So the idea that the announcement instantly solved the oil problem does not hold up. The market was still saying, good, maybe there is a plan, but show me actual movement, show me safe passage, show me de-escalation. That is the key. Plans do not move barrels. Ships move barrels. And if vessels are still delayed, if insurers are still nervous, if crews are still facing danger, and if Iran is still warning foreign forces not to interfere, then oil does not have to collapse just because a headline sounds constructive. So what does that mean for gold and silver? It means the market is stuck between two forces. On one side, you have geopolitical fear, energy inflation, and distrust in paper promises. That helps metals. On the other side, you have higher for longer rate pressure, a strong need for liquidity, and thin holiday trading in major markets. That can make rallies unstable. And yes, the holiday point matters. China, Japan, and the United Kingdom all had closures or reduced participation around this market window. Japan's main exchange was on a holiday, even though some derivatives trading was available. China was also in a holiday period. So when people look at early price action and act like it represents the full global market voting with maximum participation, that is not really accurate. Thin markets can exaggerate moves. They can make silver look like it is breaking out, then reverse it when deeper liquidity comes back. They can also hide genuine demand for a few hours and then suddenly reveal it. So I'm not dismissing the move. I'm saying be careful when the room is only half full and everyone is shouting. Now, the popular question is obvious. Can silver push toward $80 by the end of the week? Maybe. But that is not the better question. The better question is, what would need to happen for that move to be durable? If silver runs because of panic alone, that move can fade fast. But if silver holds strength while oil remains elevated, if physical demand stays firm, if above-ground inventories keep tightening, and if industrial buyers continue competing with private investors, then the move has a stronger foundation. According to recent market commentary, silver's longer-term support is still tied to recurring deficits, solar demand, private buying, and shrinking visible supplies. That does not mean every day is bullish. It means the floor under the market may be changing over time. But I want to challenge one idea here. Some people talk like silver has to surge just because the world is unstable. That sounds good, but history is not that clean. In a liquidity panic, people sometimes sell what they can sell, not what they want to sell. Silver can get hit even when the long-term case improves. That is why cash matters. That is why debt matters. That is why patience matters. You do not want to be forced to sell physical silver during a nasty spread environment. And we have seen this before. When spot prices drop quickly, retail premiums can do strange things. The paper price may fall, but the coin shop price does not always follow neatly. Then, when you try to sell, buyback spreads can hurt. That is not anti-silver. That is just how the physical market works. So if you are stacking, think like an adult. Keep emergency cash. Keep your debt under control. Do not buy metals with money you need next month. And if you're successful, share your success story in the comments so others can stay motivated. Now let's shift to the bullion tax debate, because this one matters more than people think. There was confusion around Maryland and out-of-state purchases. The simple version people like is, I'll just cross the state line, buy metals somewhere else, and avoid the tax. But taxes are rarely that simple. Maryland's use tax guidance says tax-free out-of-state purchases can still create a use tax obligation when the goods are used in Maryland, while giving credit for sales tax properly paid to another state up to Maryland's rate. So the clean takeaway is not, cross the line and you're done. The clean takeaway is, know the law before you assume you found a loophole. And no, I am not telling anyone how to file taxes. I'm telling you not to confuse enforcement difficulty with legal reality. That is a big difference. On top of that, Maryland's precious metals exemption has been changing. Recent legislative material shows lawmakers move to expand the exemption for bullion and coins, including removing a narrow location requirement tied to specific sales settings. That matters because dealers, collectors, and stackers do not just care about spot price. They care about the total cost of ownership. A small tax can change behavior. It can push people online. It can push people across borders. It can hurt local coin shops. It can make new stackers hesitate right when they are trying to build a position. And if lawmakers do not understand the difference between a collectible luxury purchase and a monetary hedge, they can accidentally punish the exact kind of saving they should be leaving alone. But here's the counterpoint. Not every tax complaint is a market catalyst. Sometimes people act like a state tax change will send silver to the moon. No, it can affect local buying patterns, premiums, dealer traffic, and sentiment. But global silver pricing is much bigger than one state. The real effect is personal, regional, and behavioral. That still matters. It just needs to be framed correctly. Now, the commemorative coin story is another example of why details matter. The United Kingdom presented a special commemorative piece for America's 250th anniversary. That much is confirmed. It was tied to history, diplomacy, and the relationship between the two countries. But the claim that it was exactly 250 ounces of silver was not something I would repeat as fact, unless the official specifications clearly prove it. That is how bad metal headlines start. Whether we are talking about Hormuz, oil, silver, taxes, or commemoratives, the same rule applies. Slow down, separate the claim from the conclusion, and do not let excitement do your thinking for you. Because right now the precious metals audience is emotional. I get it. Gold has been trading at levels that would have sounded ridiculous not that long ago. Silver has been acting like it finally wants attention. Oil is still a problem. Debt is still a problem. Inflation is not gone. And the world feels like it is one headline away from another repricing. But that is exactly when you need discipline. Not fear, not greed, discipline. Gold is still the steadier asset for a lot of people. Silver still has more torque. Cash still matters. Debt still weakens you. And geopolitical risk can create opportunity, but it can also create traps. So here is where I land. The Strait of Hormuz story is real. The shipping problem is real. The metals reaction makes sense. The oil relief story is not proven yet. The freighter attribution needs softer language. The Maryland tax debate needs legal caution. And the commemorative coin story should not be padded with unsupported weight claims. That is not bearish. That is not bullish. That is clean analysis. And clean analysis is what keeps you from buying the top because a headline scared you, or selling too early because a pullback shook you out. So watch silver closely. Watch gold even closer. Watch oil because it feeds the inflation story. Watch the actual ships, not just the speeches. And watch what lawmakers do to bullion buyers. Because the small rules often tell you how the system really views private savings. If this market proves anything, it is that metals are no longer a boring corner of finance. They are sitting right at the intersection of war risk, energy pressure, currency trust, industrial demand, and personal freedom. That is why people are paying attention again. Just make sure you are paying attention with a clear head. And before we wrap up, remember this. Nothing here is personal financial advice. I'm sharing market education, context, and my own interpretation so you can think more clearly, not so you can blindly follow anybody on the internet. Talk to a qualified professional for your own situation, make your own decisions, and never let a dramatic headline replace a real plan.